Today we look at the difference between your borrowing power and your purchase power. We're going to delve into how the banks look at it and why they differ. Your borrowing power, also known as your borrowing capacity, refers to the maximum sum that the lender is willing to loan you for the purpose of either a refinance or purchase. In order to determine this amount, the lender will review your capability to meet the monthly loan repayments both now and in the future, and will determine the maximum amount you're able to borrow from the lender. And here's an example in how the bank will look at what you can borrow and what your borrowing capacity is. So the first thing the bank will want to know is more information about your household. So whether or not you have any kids and the postcode you live in. This will all be predetermined in the bank's background. Essentially, they will determine what your living expenses are based on the number of kids and your relationship status. So as we can see here for this example with John, that as a single applicant, his living expenses are around that sort of $1,700 mark, but as a couple, that'll actually increase to closer to $2,800. Now, if John and his partner had any children, that would also increasing it to $3,400. Essentially, the higher your living expenses are, the lower your borrowing capacity is. Next, the banks will look at his income. So in this case, the higher John's income is, the more he's able to borrow. And the equation is pretty simple. It's income minus expenses equals surplus. The higher that surplus is, the more John is able to lend. There are other things that will affect John's ability to pay his mortgage, credit cards, and other debts being one. Essentially, the banks will look at your credit card limit, not the amount you have owing on your credit card. So keep that in mind. That will reduce your borrowing capacity, and also any other loans you have. So whether it's a car loan or a personal loan, and even a lease. And one of the things many people aren't aware of is their HEX will actually decrease their borrowing capacity fairly significantly, and it's not based on the balance, but rather how much income you're earning. Essentially what HEX is, it's a percentage of your income. So whether you have 20,000 or 100,000 owing, your repayments will be a constant based on how much income you're earning. The more income you earn, the more you'll pay. So if you're earning $150,000 per annum, the repayment to the HEX will be $15,000 per annum. That's 10% of your income. And this is what the bank will use in their assessment. So if you only have a few thousand owing, you might actually find that by closing off your HEX, it'll increase your borrowing capacity significantly if John were to buy an investment property. While you might think that buying an investment property will increase your borrowing capacity, it may actually reduce depending on the rental income you receive, because essentially the bank won't accept the full rental amount. In most cases, the banks will accept anywhere from 70 to 90% of the rental income. So unless that's more than the rental expense, you might actually find that a rental property will actually decrease your borrowing capacity, but in some instances, it can actually increase your borrowing capacity. Now, the next thing that's worth noting is you'll see that each lender has a different amount they believe the same applicant would be able to borrow and would have the ability to pay off. Essentially, they all have a different view of the world. So it's worth noting that if one lender says that you don't have the borrowing capacity to meet your goals, it doesn't necessarily mean that that's a true reflection of the market. It just simply means that that lender isn't able to assist. So if that's happened to you, it's best to talk to a mortgage broker. And here at Hunter Galloway, we help across Australia. And if you're looking for a great mortgage broker, we can help. Call us on 1300 088 065 or visit us online, huntergalloway.com.au. But you can see that each lender has a different borrowing capacity, and that can be significant. In this scenario, it goes and ranges from $584,000 all the way up to $680,000. That's more than $100,000 in borrowing capacity. So it's quite significant. Finally, your loan to value ratio has an impact too. So the higher your loan to value ratio, the less you'll be able to lend, because the bank's assessment rate, this thing will also change. So the higher the bank's assessment rate, the lower you can borrow. So if we change this, you can see ING will go from $670,000 to $580,000. 650,000. So you can see that also reduced your borrowing capacity. So we've talked about your borrowing capacity, but just because you've got the borrowing capacity, it doesn't mean you can actually get the money from the bank. The next thing they'll want to see is a deposit, and this will in turn affect your purchase power. So let's take a look at what that means. So looking back at John, and let's just assume his situation is simple, that he's earning a huge amount of money, 250,000 in this case, and doesn't have any children and is single. Well, then his borrowing capacity would be over $1 million. Now, if John didn't have any savings, it would mean that the bank couldn't lend him any money. Essentially, the bank requires two things. They require both a deposit and they require both your income earning ability. So to put this in contrast, let's say you're earning $1 million a year, but have no deposit, the bank can't lend you any money. If you have $1 million in cash, but no income, the bank also can't lend you any money. So if we said John is earning nil, and we can see that the bank can't lend John any money. So we need both in order to be able to help John finance a property. So back to John's situation. If he's looking to buy $1 million property, then he'll need a deposit. In most cases, he'll need roughly anywhere from an 8 to 10% deposit, unless it's under the scheme, which, depending if he's eligible, will be able to purchase with as little as a 5% deposit with no mortgage insurance. But in most cases, John will need between an 8 to 10% deposit plus additional costs. So this is an example here where we've got a first home buyer named John buying for $1 million. He's buying a property in Queensland, and as a result, he'll have government fees. These government fees account to $34,483. And there's other associated fees that will also take place. Things like lender fees, your client legal fees, that's like your conveyancing, and other miscellaneous fees that will pop up like building and pest and insurance. In total, John would need roughly $128,000. So if John, in this case, had the ability to borrow over $1 million, which we can see he most certainly does, but if John didn't have the $128,000 in savings, then the bank wouldn't be able to allow him to have the purchase power of $1 million. So if John only had $50,000, the maximum he could spend on a home would be closer to $515,000, taking into consideration an 8% deposit. This is because the maximum John can purchase for isn't based on his borrowing power. In this case, we know his borrowing power is more than $1 million, but is limited based on the amount he has in savings. And as we can see here, both your deposit and your borrowing power are interconnected. Both are important and both will determine how much the banks can allow you to spend on a home. And both are needed. So if you have one and not the other, it'll mean that you won't have the ability to purchase at the amount you're looking to spend on a home.